Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to Personal Finance for Long-Term Investors. My name is Jesse Kramer. And yes, if you missed episode 100, we recently rebranded from the Best Interest Podcast to Personal Finance for Long-Term Investors. I explained the reasons in episode 100, though to be fair, you might hear me slip up from time to time. I think 3+ years of podcasting habits are slow to fade away. But anyway, welcome to Personal Finance for Long-Term Investors. And today we have Chad Carson joining us. In the world of blogging, podcasting, YouTube, etc., I consider Chad to be one of the most straightforward and helpful resources on the topic of residential real estate investing and being a landlord. Two topics that my regular readers and listeners will know that I don't spend too much time talking about. Chad has some serious chops on the topic, and what I really like about his message is that it's very approachable to people who are either one, just looking to learn more and potentially get started, and or two, not interested in a real estate empire per se, but rather just interested in a quote unquote small but mighty real estate portfolio. You know, a couple houses, one house, 3 or 4, something like that. But before we get to Chad today, let's do a customary review of the week, and then I want to explain a little bit of my personal feelings on residential real estate. So this review comes from Shenanigan7, who said, personal finance content that everyone needs, 5 stars. Jesse is such a natural podcaster who knows how to connect with his guests and dive into their stories with easy conversation. The valuable lessons covered here are what you would get from paid coaching or advising. Start downloading episodes now and expand your knowledge. Thank you, Shenanigan. If you're listening to this, drop me an email to jesse@bestinterest.blog. Yes, my email address is still associated with my blog, The Best Interest. So the email address is jesse@bestinterest.blog, and we'll get you hooked up with a super soft Best Interest t-shirt. And listeners, thank you as always for the emails, for the questions, the YouTube comments, the reviews on Apple Podcasts, the ratings on Spotify. I really appreciate it. If you haven't done so yourself, please share your thoughts with me and share your thoughts with prospective future listeners. Let them know why they should tune in too. Okay, so let's begin to talk about residential real estate, investing in residential real estate. It's an interesting topic for anyone looking to build wealth, especially for those who aren't necessarily convinced about the idea of stocks or bonds or more traditional publicly traded investments, or maybe for people who are looking for diversification away from stocks and bonds. I think one of the main reasons why is that real estate feels very tangible. Unlike stocks or bonds, yes, you're buying a piece of a business in a stock, or with a bond, you are loaning someone money and expecting to be repaid. It doesn't necessarily feel tangible always because you're kind of buying a contract, you're buying a piece of paper, or you're buying a line in a spreadsheet somewhere that says that you own 100 shares of Apple. Real estate instead is something that you can touch, you can live in, you can drive by, right, to show off to your friends and family. And it's also an investment strategy that many people equate with stability and long-term growth. Unlike, say, the stock market, where many people see the volatility of the stock market and it kind of turns them away, they don't really like it. Well, other than a few rare occasions in history, volatility like that doesn't exist in residential real estate. It tends to be more stable. But is it as straightforward as just, okay, buy a house, step 1, rent it out, step 2, and then rake in the cash, step 3? Well, not quite. So let's dig in, starting with some of the pros. I think one of the first and most obvious pros of residential real estate is the income that you receive. If you buy the right property in the right location, rental income can be a consistent and reliable stream of cash flow. Every month, your tenants will pay you rent. And after you cover your expenses like mortgage payments, insurance, maintenance, what's left over goes straight into your pocket. It can be a terrific regular income source. And then there's the appreciation in the underlying asset. Now, historically, real estate values tend to go up over the long term. And there are dips like 2008 that can be very, very painful dips. But over the long run, over decades, property prices generally rise. We've seen that in abundance over the last 5 to 7 years. And that means you're building your wealth without doing much beyond holding the asset. And then we get into some of the real magic of real estate, and that's leverage, right? The magic of leverage, in my opinion, is one of the primary drivers behind real estate being such a powerful investment if it's done right. Now, I'm sure I've talked about it here on the podcast. I know I've written about it on the blog. Leverage is also a financial weapon of mass destruction, right? We have to be really careful with leverage, but if we use it correctly, it can be very, very powerful. It's kind of like nuclear energy, I suppose, right? It's the kind of thing that on the one hand can power entire cities, and on the other hand, it can also blow up entire cities, right? It's all about how you use it. Real estate is one of the few investments where you can use other people's money, that's a loan from the bank, to make a purchase. So if you buy a $300,000 property with a 20% down payment, that's $60,000 of your own money. But if you do it right, you will reap the benefit of the entire $300,000 in value. If the property appreciates by 5%, well, that's a $15,000 gain, not on $300,000. It's a $15,000 gain on your 60. It's a 25% return. It's hard to do that consistently inside of a brokerage account investing in stocks and bonds. Now, if the value of the property goes against you, well, leverage really hurts. Or if simply you don't run your real estate like the business that it is, and you really need to think about it like a business, well, maybe your income, maybe your cash flow is negative, and you're really not getting any sort of long-term benefit from owning the property. The appreciation is nice, but by the time you pay off your debt with interest included, maybe you're not getting any sort of gain. So again, leverage can be very, very powerful. You'll hear Chad talk about leverage today. And in the bigger picture, it's one of the great parts about real estate investing. Yes, there are tax benefits too. You can usually deduct mortgage interest, property taxes, and even some depreciation, which is essentially Uncle Sam letting you claim a loss on an asset that actually might be gaining in value, kind of just like finding random money in your pocket every year. That's something that you'd want to talk about with your accountant to make sure that you are including the tax benefits properly in your annual tax return. Another big plus in the real estate world, as far as I see it at least, is control. When you invest in real estate, you're not just throwing money into the stock market and hoping for the best. You're not trusting your money with some other executive board to run a business as they see fit, whereas you are just really a junior partner that doesn't get to make any decisions. When you invest in real estate, your own properties, you can make decisions that directly affect your investment's performance. It is 100% in your control. You can renovate to increase property value. You can raise rent to match the market rates. You can choose different types of tenants to minimize risk. There's a level of agency here that you don't necessarily get with stocks or with mutual funds. And then there's the diversification argument. Real estate can balance out your overall portfolio, especially if most of your assets are in stocks and bonds. When the stock market takes a nosedive, well, your real estate investments are probably going to hold steady, providing a hedge against that volatility. But before you go out and buy your first duplex, we need to pump the brakes a little bit and talk about some of the cons. So first up, the costs of real estate are one of the major cons. Real estate is not cheap. You've got to come up with a down payment, closing costs, an emergency fund for repairs. Then there's the ongoing stuff, the property taxes, the maintenance, the insurance, the lovely calls at 2 a.m. when a tenant's water heater decides that it's retiring early. There are a lot of costs that can add up. And if you are unlucky enough to pick the wrong property, those costs can absolutely outweigh the benefits. And that brings me to another point when it comes to the luck or the lack of luck of picking the right property. We're talking here about the example I used before is investing $60,000 of your own capital into a single house. Now, for many of you listening, you might not have $60,000 out there invested in a single company, but having $60,000 in a single house is way riskier than having $60,000 in a single stock. Because when you have it in a single house, you are investing right in one single piece of property. You're investing in one building that you hope was built right. You're investing in one building that you hope all the previous owners took care of it. You're investing in one neighborhood inside of one city, right? You're investing really in one market where you're really crossing your fingers that the long-term prospects for that market are positive. If you're investing $60,000 in Apple, well, yes, it's concentrated. It is a concentrated investment, don't get me wrong. But at least in my opinion, the risks associated with Apple, this massive company with all this momentum behind it, those risks are far smaller than the risks of investing in a single property. So that's one of the cons of investing in residential real estate. Another one are the tenants themselves. Being a landlord is not for the faint of heart. The dream tenant, they pay rent on time, they keep the place spotless, they never bother you, they might even mow the lawn for you. The nightmare tenant though, they trash your property, they ghost you on rent, they leave you with legal bills to evict them. And let's be honest, tenants are humans, just like investors are humans. And we talk here about, the fallibility of investors and our lizard brain and our monkey brain leading us to do things that aren't necessarily in our own best interest. Well, tenants are humans too, and they have emergencies, they lose jobs, they just flake out sometimes. It's part of the deal of being a landlord, and it's no fun. Another one of the cons is liquidity. Real estate isn't something that you can just go log in and sell with a few clicks. If you need cash quickly, it's not going to be easy to offload a property, especially in a down market. Real estate transactions take time, often months, and they come with costs like agent fees, closing costs, legal fees that will eat into your profits. We also have to think about market risks, right? We already talked about this a little bit. Local economies matter. A city with a booming tech industry might see property values soar, but if that industry crashes, so might the real estate market. And risk isn't just national, it's hyper-local risk. So you need to research neighborhoods, school districts, crime rates, future development plans. It's a lot of homework. You'll hear Chad dive into a lot of this later on. It's very interesting to hear his process. One of the last cons that I think about is the time commitment. Real estate can feel like a part-time job. If you're doing it right, it probably will feel like a part-time job. And if it doesn't feel like a part-time job, it's probably because you are outsourcing a lot of your work, which also means you are outsourcing a lot of your profits. Even if you hire a property manager, you'll still need to manage them. That's assuming you find a good one. The passive income people rave about real estate, but it's not so passive when you're unclogging toilets, or negotiating lease renewals, or keeping up with the latest landlord-tenant laws. So, should you be a landlord? If you're considering becoming a landlord, I think you need to think about your own personality. Are you patient? Are you good at managing people? Are you handy? Or at least willing to pay someone else who is handy? Being a landlord isn't just about collecting rent checks, it's about solving problems. Some of those problems are as small as a leaky faucet, but sometimes they're as big as a lawsuit. You also need to consider your personal financial goals, something we always talk about here. Are you looking for monthly cash flow? Are you banking on long-term appreciation? Maybe both? Well, knowing your goals will help you choose the right property because not all real estate investments are created equal. A property in a high-growth city might appreciate faster, but it also might come with lower rental yields. A property in a stable market might generate consistent income but offer little appreciation, so you need to pick your poison there. Another consideration, and a big consideration that we're going to talk about today with Chad, is scalability. Owning one rental property might be manageable, but what happens when you own 5 or 10 or more? The challenges in some cases multiply, but in other cases, you get economies of scale working in your favor. You're probably going to need to form an LLC for legal protection, maybe even one LLC per property. At some point, you're going to want to hire a property manager or outsource to a real estate investment firm. They're great problems to have if your portfolio is growing, but there's still problems that you need to solve. For some people, real estate investing is a fantastic way to build wealth. And for others, it's simply a headache waiting to happen. And I can speak to this firsthand. I have multiple people I know, some of them even clients, so I can really see under the hood. And real estate investing, commercial or residential, the idea of real estate leverage, right, borrowing money and investing it wisely and taking care of these properties has led to amazing success for them. I also know some people personally who at some point in their life owned some residential real estate, maybe 4, 6, 10 doors, something like that, a couple houses in a market. And after 5 or 7 or 10 years said, this sucks. I cannot wait to sell these houses. I'm going to take whatever income and appreciation I've gotten so far. I'm going to take all my chips off the table. I hate being a landlord. It works differently for different people, and knowing yourself is a big part of that. If you're not ready to buy property outright, there are other ways to get in the game. There's real estate investment trusts, which let you invest in real estate without the hassle of owning property. Crowdfunding platforms are another option, allowing you to pool money with other investors to buy larger properties or developments. There are private real estate investing opportunities. That's something where, I work at a firm where 13 or so years ago, we realized that our clients were coming to us asking us questions about real estate investment opportunities. And we ended up providing a service to those clients where we will go out and find opportunities for them to invest in. Really interesting, lucrative, vetted investment opportunities, but it takes all the heavy lifting off of our clients, right? It puts the heavy lifting onto our investment analysts, forming the LLC, et cetera, et cetera, et cetera. But then at the end of the day, the individual investors, folks like you, they get the benefits from investing in this real estate. So these kind of alternatives, whether it's a REIT, a crowdfunding, a private investment, they can offer diversification and potentially strong returns without the daily grind of being a landlord. So should you invest in residential real estate? Maybe, maybe not. But whatever you do, you got to make sure the numbers make sense. Real estate isn't magic, right? It's just math. And when you do it right, it's math that can pay off for decades and decades and decades. But a solid investment starts with a clear plan, with realistic expectations, and maybe a really good plumber on speed dial. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. And now we're going to bring Chad Carson on to the podcast. Though most people call him coach. They call him coach because he actually played football at Clemson University. You'd never know it. He's just a kind, soft-spoken guy. Not saying that football players can't be kind. Other than the fact that he's 6'4" and clearly a strong, athletic human being, you wouldn't suspect that he's a football player. What he is now is a real estate investor, world traveler, father and husband to a great family. He shares a lot of his real estate investing expertise with the wider world of DIY investors like you. And specifically, Chad makes a strong case for what he calls the small but mighty real estate investor, saying, you don't need to own triple-digit properties. You don't need to have a full-on real estate management company. Instead, we can start with the end in mind, start with your goals in life, start with your financial goals and your timeline specifically, and then work backward to an appropriate amount of real estate exposure for you and your family and your personal portfolio needs. Anyway, I don't want to bury the lead too much, so without further ado, here is Coach Chad Carson. Chad, thanks for joining us today. And I think of you as one of the internet's go-to resources for the everyday kind of mom and pop style person who is interested in owning some rental real estate. Perhaps they already own rental real estate or a small duplex or something like that. We're not really talking the 1,000-door real estate emperors here. But because of that, I can think of all these questions that come to mind, or at least come to my mind, about owning a rental house. Maybe it's the location, finding good tenants, doing due diligence, how to fund it or finance it. And so I kind of want to start going down that lane, if that's okay with you. How does the average mom and pop investor, someone who might be listening today, go about getting good answers to all those kind of question marks before diving into this rental real estate world?
Yeah, well, thank you for having me and thank you for the introduction. The thing I love about real estate for people who are curious about it is that it's not rocket science. It can be intimidating, but the good news is that the things that make good real estate investments are very intuitive. And if you've lived in a house as a rental or lived in an apartment as a rental, or if you've owned your own home, some of the reasons you chose that property to live in are the exact same reasons that you want to choose a good real estate investment, at least the approach that I take for I call it small and mighty investors. And so that intuitive approach means pick locations where people want to live. It's as simple as that. Like if there's a demand, because you want demand, you want people to live in your rentals. You eventually want to be able to sell your rental one day. So you want people who want to buy it. So when I'm coaching people to pick locations, which is probably the most important fundamental of real estate, is you've heard people say location, location, location. Well, it's because you're really not buying a house. You're buying a neighborhood. You're buying a region of the country. So I almost look at it like, imagine the solar system. The sun is the center of the solar system. Well, when you pick a real estate investment, you want to find a city or a region that has like an economic sun. You want a place where there's people have good jobs. So I grew up in Atlanta, Georgia. So Atlanta is like the economic sun. So at the center, there's lots of jobs. There's lots of people working there. And then but I'm a small investor. So then instead of investing right in the center of the sun where it's really expensive, I like going to these satellite cities that are like 15 minutes, 20 minutes, 30 minutes outside the city. And there's actually a term that I read one time called suburban locations, SURBAN, meaning it's suburban, but it's got a little bit of an urban feel to it. It's got a town center. It's an old town that has a court square or something where it's walkable and it's still a good, interesting place to live. It has its own gravity, but it's still kind of close enough to the sun that you have jobs and people can work, but then you have this quality of life and this affordability that happens more in the suburbs than the city. So that's one idea. Maybe that's a good place to jump off.
Yeah, it definitely is, because a couple questions immediately come to mind. I'll just start with one of them, which is that idea of kind of doing your own regional economic research, it sounds like, as part of the house buying process. Do you have any metrics or tips that people can look into when it comes to evaluating? It's like, naturally, I would just look in my own backyard, but how do I'm kind of biased towards that. So how do I zoom out and really look at the bigger picture of if I should even be investing in my local region to begin with?
Well, the good news is most parts of the country actually are doing pretty well. We have a kind of a benefit of abundance in the United States, and also Canada. If people are listening in Canada, I mean, just most parts of the country are doing well. But I would say let's start with the opposite of what you don't want. A place where you would not want to invest is typically a place where the population is decreasing. Population growth and real estate investing prices are very closely correlated. And one of the reasons you think about basic economics is it's a supply and demand thing. It's really difficult, although it happens in bursts, where it's really difficult to build new housing because of the cost of it, because of zoning. There's a lot of reasons why, but supply can be kind of limited. It goes up in bursts. But so really what you pay attention to is the demand. And so if you go to, like, let's say, for example, you go to a small town that has one factory and that factory goes out of business, that all of a sudden the demand for your rentals and your sales is gone, like evaporates. That's where you could see houses going down by like 50%. And that's also why I say go to an economic sun. There's tons of economic suns in the United States. Like I mentioned Atlanta, the Southeast, the Southern United States is doing pretty well right in the last 10, 15 years. But the last 2 years, like as of 2025, what they used to call the old Rust Belt, the Midwest, upstate New York, those have been some of the hottest parts of the country. So it's like, I would say just pick a place that and use, you don't have to do like super analytical. Like if you were a hedge fund or something, you would get really analytical, quantitative with this. As a small investor, I think you literally can look at things like there's a U-Haul. If you go to U-Haul's website, they have a trend. They show you where most people are moving in the United States. Like people, where are the U-Haul trucks going? South Carolina, where I live, happens to be one of the number one this year. It's kind of interesting. But just like find a little trend like that. Go to the local Chamber of Commerce website to find out where do people work? Like when I'm coaching people, I say, like, do a little one-page description, like almost like a promo of your town. Why should I live there? What am I going to do? What are the attractions here? Is it the natural resources? Is it a lake? Is it the fact that it has 3 S&P 500 index, companies that are really big? Is it because of the hospital this year? Like there's something that's drawing people to your town. Make sure you know why that is and make sure it's a little bit more of a diverse economy instead of the one factory town.
Yeah. Well, you hit on a lot of local pain points there. With the one factory town, I'm thinking to myself, Rochester was home of Kodak back in the day. Right. And Kodak's demise, even in a metropolitan area of 1 million people, Kodak's demise was really impacted the region over the last 30 some odd years. But to your other point there, Chad, which is people are moving back to the Rust Belt, which I think a couple of Rochester's suburbs, a couple of our zip codes were in like some sort of metric, whether it's like home buys or days on market being super low. The idea being that demand for some of our suburban housing here in Rochester is on the rise again. I'm interested though, Chad, so kind of personal finance and investing has this common problem, I'd say, and whether we're talking about real estate investing or some other type of investing. And the problem is, well, we don't want to go in blind. So we want to do our research. And as we do our research, it kind of builds up confidence. And hopefully, eventually, we reach a point where we're confident enough to pull the trigger and actually go off and do the investing that we're hoping to do. But a lot of people get stuck, and they either get stuck on the hamster wheel of analysis paralysis, and they keep on thinking they need to learn more, and they never actually do the thing. They never actually invest. Or maybe they end up on the other side, which is they dive in head first before they even know how to swim, and they end up way over their heads. Is there anything that you can recommend, or in your coaching experience with clients or just in your own experience? I mean, how do I build enough confidence to dive into this pool and actually execute on it?
Yeah, well, the first is that you're absolutely right. There's a ton of things that can overwhelm you as whether you're doing personal finance, investing in the stock market, or investing in real estate. I mean, it can be overwhelming when you're new. And so what I can try to help with is let's narrow down all of those things you have to worry about to like the top things that could really hurt you. Like, what are the things you really need to worry about? And we've already covered one of those, like location. The biggest mistakes I've made in my career have been on a micro scale, investing in the wrong locations. So if you get the region right, if you just find a region where it's generally good to invest, and then you go to a location, and I'll give you a little rule of thumb. This is definitely not scientific, but every town has like a scale of prices, like the highest price properties all the way to the lowest price. And real estate investors use like a rough rule of thumb, calling them A, B, C, D. The way I look at that, if you go look on Zillow, this is an easy exercise to do. The A properties or the A neighborhoods are the most expensive properties in your town, both by price of resale and also by rent. So you can actually go on a Zillow map for free and look at that today and just say, all right, that's the A area. That's where the $1 million properties are in my town. Well, go down a level. And by the way, the A locations are mainly owner occupied. So these are almost all people owning their homes. There's very few rental properties in an A location. Now go one step down, we call it a B location. There might be like 80, 90% owners, but then maybe 10 to 20% rentals. That's one of my favorite places to own right now. It's one of the safest places. You're not going to get as good a cash flow necessarily as you will going down the rung of the ladder a little bit, to what like a C location would be more like a blue collar location with maybe 50-50 rentals and owners. It might be a neighborhood that's older, that's kind of gone through some transitions. It used to be a or B, but it's gone through, all neighborhoods go through transitions. And then you get to D, and D can be a little controversial because sometimes historically it was neighborhoods that were disinvested for all sorts of reasons. There was redlining going on cities. And so no fault of the people who lived there. It was just a location that was just had crime, had things going on. There are investors who invest there, and some of the D locations are coming back and doing well. So there's ways to make money there, but as for a new investor, you don't want to start there. Probably don't want to start in C. If you have the means to do it, I would say B minus would be a good location. In my town, just to give you real numbers today, in Clemson, South Carolina, which is probably similar to Rochester prices, a single family house that would be worth like $300,000, maybe $250, would probably rent for $1,800, $2,000, somewhere in there. So it might be like a $2,000 rental that you buy for $250 to $300,000, somewhere in there. That's an example for me of a B class property. And the reason that's more attractive, so to answer your question, is like, how do you avoid the biggest mistakes and actually get off the sidelines and actually do it? Number one, start with a region and a neighborhood that is less scary, that you can it's just easier to do. And then the second two mistakes that I would say you want to avoid are the remodeling of the property. It's fun to watch HGTV and see these fix and flip shows and all that, but they leave out a lot of details because a project management of remodeling projects is hard. It's not easy. I've been doing it for 21 years and it's still hard. I still make mistakes. So I would say find properties that have at most cosmetic remodeling. Hey, change the carpet out, paint some walls, but like the bones are good, the kitchen's good. You don't have to rip out bathrooms. You don't have to do electrical stuff. Avoid like really old properties that haven't been remodeled lately. If you get the right location, avoid big fixer-uppers. And then number 3, get your financing right. And what do I mean by that? The biggest deal is make sure the payment that you make on your mortgage is a lot less than the rent that you're collecting on that property. So a rule of thumb might be like 50% or less would be kind of a good kind of starting plate. That you want to get more detailed in your analysis than that. But if your mortgage payment's $1,000 and your rent's $2,000, it gives you a lot of leeway there to pay taxes and insurance and maintenance and management. And what that might mean today, because interest rates are a little bit higher than they've been, you might have to make a bigger down payment to make that work. And that's okay. Like, you don't need to hit a home run on your first deal. And so to summarize all that, get the right region, get a property that's not a fixer-upper, get a mortgage payment that's reasonable, low. And I would even say a 30-year fixed is the best scenario. Don't try to get crazy, weird adjustable rates and all that stuff. Just get a 30-year fixed. If you do those 3 things, you might not hit a home run, but you're not going to get killed. You're not going to lose a bunch of money.
What's the argument for those who don't know, Chad? What's the argument for getting a mortgage in the first place? Understandably, for some people, it might be the only way that they can finance the house at all is through borrowing money. But if someone is sitting out there and they're saying, you know what, I've got money in my 401k, I've got a lot of stuff set aside, we're sitting on too much cash as is. Yeah. And rather than plowing money into the stock market right now, I might throw a couple $100,000 at a rental house. Should that person do that? Or would you still advise they go the mortgage route?
I think it depends on what stage of your investing you're in. And I use a little rule of thumb to help people figure out what stage they're in. I'd say there's 3 rental stages. Your starter stage is when you're just a baby investor, you're just getting started. Your goal is just to get a deal or two, and you're early in your wealth building journey. And then you get into the wealth building phase where you're like, I have a $50,000 nest egg or $100,000. I'm trying to grow that to $1 million. That's like the second stage. The third stage, which just sounds more like your question, somebody already has a pretty big 401k. They're getting closer to retirement. I call that the harvester phase, where you're actually trying to have more time, have more cash flow. Your peace of mind and your risk reduction is really important to you. I'm actually in that stage personally now. I'm 45 years old, but I've been investing for 21 years. And so I'm in the harvester phase. I don't like borrowing money like as much. I like either making a big down payment or paying cash for something. So I have no problem. If somebody wants to do that and they have $200,000 and they want to go buy a rental property, the downside of that, the reason people use leverage is because your return on investment is typically going to be higher by using leverage. If things go well, they're going to go a lot better when you use debt.
Right.
But if they go bad, if things go badly, then debt actually makes it even worse. So that's where I've only seen one way that friends of mine or people I knew went out of business in real estate, and it was because of their bad debt, because they didn't make their mortgage payment during the Great Recession. They had all sorts of crazy kind of commercial notes. Even today in 2025, they're not in the residential world, but more the commercial world. there are investors losing 100% of their money because of big, huge apartment complexes where the debt reset and the interest rates are higher. So getting the debt right is really important. So if you just pay cash for it, all good. You're gonna get a lower return, but when you're in the harvester phase, it's not as big a deal. You're not trying to grow as much as trying to have peace of mind, sleep well at night. So either one can work.
That makes sense. Going back, you mentioned some of the renovations as being a sticking point, that you want to avoid a house that requires major renovations, especially if it's your first foray into real estate investing. Only out of curiosity, do you pick up a hammer and do the work yourself, Chad? Was there a time in your career when you did? Or if there was a time when you did some of the renovation yourself, what was that transition like from being the laborer to now just being the project manager?
So I know my skills, and I am not a skilled fixer-upper handyman, although I have people I know, other investors who do a great job, and they do choose to get involved and get their hands dirty. So it just depends on your skills. I'm more of a negotiator, a spreadsheet person. I just like the money and the financing. You just have to know what your strengths are and what you're good at. The cool thing about real estate is there's a bunch of areas you can add value. And you can add value in the finding the deal, which is one of my favorite parts of it. Is you can hunt for a deal, find a property that nobody knows about, negotiate directly with the seller, even though it's not even on the market. I love doing that. I do a lot of just direct outreach to sellers and find properties like that. You can add value there. You can add value by fixing the property up, and instead of hiring a contractor, you can do a lot of the work yourself. That's cool too. And for somebody who's just doing one deal a year, that could be an awesome way to build some wealth and have some sweat equity in a deal. So I think that's viable too. You just have to kind of figure out your strengths. For me, it just wasn't my interest. It wasn't my strengths. I'm just not good at it. You can ask my wife. She's like, why do I always have to change all the light fixtures out, Chad? Why can't you do this? And I'm like, well, I'm really not in the real estate business. I'm in the finance business. I just kind of joke about it.
Well, how about the idea where if you are getting into this process, odds are you have a full-time job, maybe you have a family, you've got a busy life. I mean, that's really the point, is that you have a busy life. And then on top of it, the idea is you have to gain some sort of expertise in real estate investing, or at least you have to learn enough to really know what you're doing. So how do the people that you help, Chad, or how do you recommend that someone go about this process while also maintaining all the other responsibilities that they already have in their life?
I'd say two things. Take it slowly. I have a mentor named John Schaub. He wrote a book called Building Wealth One House at a Time. And he always talked about just buy one house, take a deep breath, take a break, and just absorb it, learn it. Don't try to get too fast. It's like when you run a race, there's always people like in a 5K or a 10K race who sprint out ahead at the beginning. You're like, run. And you always see them a half a mile down the road, and they're huffing and puffing on the sidelines, right? That you can do the equivalent in real estate and business of starting too fast. So pace yourself. Don't try to get ahead of yourself. That's one way, because just doing one property, you're not going to overwhelm yourself. Yes, there might be some hassles here and there. The first property I bought as a rental was a fourplex that I moved into. I moved into one unit and I rented the other 3 units out. That's called a house hack, where you can rent out part of your property you live in and help cover your mortgage payment. I think that's one of the best strategies for those of you anybody who's interested or willing to live in a property that they can rent out. It's awesome. You can do it by living in a duplex, a triplex, a fourplex, or a house that has an accessory dwelling unit or a granny flat, something like that. That's a great way to do it. But the point was I learned by doing it. I didn't know how to manage properties. I didn't know what I was doing. So I just had to learn. But YouTube's free. You can listen to podcasts like this. There's lots of information. There's free software out there, or very low cost software. Zillow has a rental manager where you can collect rent for free. I use that a little bit. There's also some paid ones, Avail, Avail, and a bunch of other ones. That Stessa is another one, Stessa. So if you just look up rental software, they basically have systematized things that 15 years ago, you would have had to pay $1,000 a month to a property management software to do the same kind of things they do today for free or very low cost. And that's good for us as small landlords, because we can use that software. We can look very professional with our tenants. It can help us stay organized. You can have to learn some things, but it's not going to be rocket science again. It's going to be the hardest thing to do is build a team of people to help you do what you're trying to do. So if you're not going to be fixing plumbing and doing all that, which I don't, you just got to build a network of people.
Yeah.
So that takes time. If you're self-managing, you have to just meet other investors and talk to people. But you can also hire a property manager, and then you just have to build one relationship with the property manager, and then they hire all those other people to help you out. So there's
Right.
a couple ways you can do it.
I assume there are probably some cost differences. I mean, the more the more that you keep in-house and not using a property manager, the more that you earn, the better your margins. Who are some of those team members, or at least the very biggest, most important team members that you have, Chad?
Well, I use a property manager these days. I used to manage it myself, and that's fine. But I pay 10% typically of the rent to a property manager, which for me is worth it. Like they earn it. Like property managers are not getting rich. But I'll just tell you that it's not a high margin business. So I think it's worth it in the long run to hire a property manager. For me, it has been because let me qualify that. I have student rentals is a big part of my portfolio. Those are a little bit more active. There's a lot more leasing. They move out every year or two. On the other hand, I have some properties I do still self-manage. They're single family houses where families live there and they stay for 4 years, 5 years, 10 years. So I think picking the right property makes a big difference in how active you're going to have to be. I have people I know who have 10 properties that they self-manage and they work 2 to 4 hours a month, something like that on their properties. Once they're stabilized, if you're getting them bought and all that, it takes more time. But I lived in Spain with my family for a year. And I counted, I measured it with all my properties that we have. I spent 2 or 3 hours a week managing the managers. So once you get stabilized, this could be a very part-time business. You still have to pay attention to it. You still have to do bookkeeping. But people pay attention to their stocks too. They look at the stock market for 2 or 3 hours a week as well, and they worry about it. Whereas real estate, you can actually have some control over, the biggest problems I've had of tenants not paying, a big maintenance issue. And most problems I have, like the maintenance, you can solve that problem by writing a check. You pay some money and they fix it, right? It's not great, but you can solve it. It's just money. Whereas, there's some tenant issues, there might be some personality issues, but if you have a property manager, they'll solve that too. And it's just money. You're going to miss some rent. So I try to remind myself of that because it is stressful and people, tenants and toilets and all this stuff. You write a check, you solve it, and then you either get a higher return or a lower return, but it's not the end of the world.
That's interesting, Chad. And I should have asked you this back when we were talking about loans and leverage, because something that a question that I've heard more than once is the idea is when you get started, if you don't have really any seed capital to begin with, well, is the first thing you have to do to save up money just to get rolling? Or is there a way with basically very little of your own capital up front to somehow secure a loan and get started in this business? So what are the pros and cons of kind of the various levels of leverage that one can take? And what do you tend to recommend for people that you work with?
Yeah, like if you just took the average in real estate, most loans require you to put 20 to 25% down. That's like the traditional, typical way you do it, especially as a real estate investor. So if you're going to get a real estate investing loan, expect 20 to 25% down. Now, that being said, a lot of people don't have, if you're buying a $300,000 property, that's a lot of money, like 60 to 80,000 bucks. That's when you're first starting, that's really difficult. I get that. I was the same boat. So then that's where you have to get creative. And I mentioned house hacking earlier. In addition to the benefit of having renters help pay for your mortgage payment, another benefit is when you move into a property and you live in the property, there are actually lower down payment programs where you can get into a property for 3.5% down. That's an FHA program, Federal Housing Administration. If you happen to be a veteran, there's a 0% down loan program, which is probably the best out there. There's also, but even with conventional mortgages, which are like the typical, if you ever hear like Fannie Mae and Freddie Mac or some terms thrown around, those are your conventional mortgages. They have 5% down payment programs as well if you live in the property. If you choose to live in a property, and you could do what I talked about earlier, living in a multi-unit property, but even if you just live in a house that is not going to be your forever home, but it's a nice, simple house, it's good for your family at that time of your life, instead of selling that property, keep the property and then go buy another house to move into. And that you keep that property as a rental. I've seen people build a 3, 4, 5 house portfolio just by doing that over a 10 to 15 year period, just moving a few times. So that's where you can by being a little creative, by being willing to move, use your housing as a kind of a leverage point, you can get in with lower down payments, and then you keep that loan over time. And that's the way I got started. That's the way a lot of people get started. And I think that's one of the best approaches.
I still remember it was 2019 and a guy from Fidelity came in to speak to my then employer about personal finance in general and about our 401k plan in particular. There were 60 or so of us who attended, mostly 50 plus years old, clearly with retirement on their minds. And nothing against this individual from Fidelity, but unfortunately, the guy just didn't really know what he was talking about. It ended up being a major disappointment. And a bunch of my colleagues afterwards said, in short, man, we're really thirsty for good financial retirement information. Where do we go find it? Now, does that sound true, listeners, for you and your colleagues? Last year, either in person or via Zoom, I spoke to about 800 employees at 11 different organizations, sometimes about personal finance in general, sometimes about specifics of their retirement plans, sometimes about the nitty-gritty details of Social Security and withdrawal planning and retirement math. The point being, if you're interested in inviting me to come talk money to you, to your colleagues, where you work, that is absolutely something I'm interested in talking to you about. Simply drop me an email to jesse@bestinterest.blog and let's start a conversation.
You've mentioned it here, that the small and mighty real estate investor. That's a term that I think you coined. I think that's your phrase, right?
I might have stolen it from somebody, but I run with it anyway.
but I really like the idea, because a lot of the real estate content that someone might be exposed to online is, how to build this multi-hundred unit real estate empire, when really your focus is on no, you could build a wonderful life. You can reach financial independence. You can do all these great things with single digit doors, or maybe a dozen rentals or a couple dozen. It's just a smaller, but certainly mighty empire, if you will. But the question then is, for me at least, scale. And it's an understanding I have, maybe it's true or not, is that the more you scale in real estate, kind of the better your margins become. You have one plumber that can handle a ton of different properties instead of one guy who only has a few different properties. And if you're small and mighty, that the small might hurt you in terms of those margins or that lack of scale. So I guess I'm just asking myself, first off, correct me if I'm wrong, because odds are I'm probably missing something important. But then the second part of the question is, how many properties is enough? And how does the average small time landlord get there?
Yeah, this is definitely a button for me. Thank you for letting me get on this pedestal.
Yes, but, I love it. I love it.
There's a lot of. I think it's oversold that you have to go big. There's people out there who talk about you should 10x, you should go big, and that in business schools, for example, you'll hear a lot of times saying they talk about scale and how if you're a big business in the tech world, there's a lot of benefits to having an economy of scale, of having one product you sell to 1 million customers. I get that. That's a pretty good business principle, but it doesn't apply. It doesn't have to apply. There's always pluses and minuses. There's a lot of risk that goes on when you grow. For every person who makes it with this big business, there's thousands of others who crash and burn and lose all their money. And so I think if you want to find a way that is both safe and resilient, and you can actually have a high probability of succeeding with a successful business model, the small and mighty approach, not only to real estate, but just to business in general, I think makes much more sense for those of us who don't have ambitions to necessarily take over the world and be we just want to have a life that's flexible and freedom and options. Mm-hmm. And for me personally, I'll just explain my strategy. My goal was always to travel. My wife and I, when we first met, was we wanted to go live abroad and have time to, when we have kids, now we have 2 kids who are 13 and 11, but before we had kids, we wanted to live abroad and have them speak Spanish. My wife's a Spanish teacher. And that was just that's our why, that's our goal. Mm-hmm. And having 1,000 units would not necessarily help us accomplish that, because it would take all of our time. It would require me to be on site. Yes, I'm sure the people who have 1,000 units, so you could hire people to do all that stuff, but it is there's always on your mind. There's always things going on. So what I like to find is a sweet spot where you're big enough to accomplish all your financial goals, but let's flip it on its head. Let's say, what's the simplest, smallest portfolio that I can have that still accomplishes my goals? Because the simpler it is, the less hassle it's going to be, the less moving parts it's going to be, the more I can travel, the more I can do the things I want to do. And so it's really just starting with that thing you want to do in your life and then say, how much would that cost in both terms of time, in terms of money? And for me, I want to be a time billionaire. I want to have a ton of flexibility in time, and then I want to have enough money, because the money is there to pay the bills, is there to pay for the flights, is to do all that. But what I really need to live is the time. And so for me, let's give you a specific example. Every portfolio is a little different, but I always use this 10 property portfolio example. So let's say you had 10 properties that are kind of similar to the numbers I was sharing earlier, where each property rents for $2,000 per month. And let's say after all your expenses, and let's say you also paid these properties off. You start off with debt, but eventually you pay them off 10, 15 years from now. Yep. Well, those properties that rent for $2,000 a month, maybe you make at least $1,000 per month, probably a little bit more, after all your expenses are paid. So $1,000 times 10 properties is $10,000 per month, times 12 months, that's $120,000 per year. So I could own 10 properties, which you have to if you don't own rentals, just trust me that that's a very part-time job. It might sound like a lot, but owning 10 properties If you have a property manager, it's going to be a couple hours a month, just doing some bookkeeping. If you self-manage it, maybe it's an hour or two per week, but you have $120,000 per year coming in on a very part-time job. And the question now is like, what do you do with the rest of your time? But you still have a lot of flexibility, a lot of time. And that's the reality of what I've seen people who get to that harvester phase. It's not always easy. There's a lot of bumps in the road, but that's like the end goal, is having the small portfolio that is either low debt or no debt paid off. So it's a stable kind of harvester portfolio. And then you start doing what you set out to do in the first place, which for me was travel, living abroad, starting other passion businesses, which for me is writing a book or teaching or doing a podcast, talking to you about it. So this is what I love to do, is teaching. And so, but I think many of us get caught up in careers and jobs that aren't necessarily what our calling was. It's not what we are passionate about. We just do it for the paycheck. And what I think is cool about financial independence in all its forms is it frees up those options for you to start saying, just like you did when you were a kid, like, what do I want to be when I grow up? Like, what do I want to do with my time? And that's beautiful. Like that opens up a lot of possibilities that are much more than money. It's much more than getting 1,000 units. It's much more important.
Yeah. Flexibility, optionality. And I like what you were saying there, Chad, just getting into this whole process with the end in mind. I think a lot of people, whether it's the stock market, whether it's real estate, they say, well, I'm going to own it because I've heard that's a good thing. Or I'm going to own it because other people in my life own this type of asset too. Or I just want more money, right? I'm going to invest because I want my money to do something. I want more money. And that's okay. That's a start. But I do think it's more important to start with the end in mind and say, okay, so now we've fast forwarded 20 years and you have more money. Now you have enough money to do a lot of different things. What do you want to do now? Is the answer still just more money? And eventually, I think most people will realize, oh, no, there's actually some other life goal in mind. And the money is just a means to an end. It's just a tool to help you get there. And now you could start to think about right-sizing your portfolio, whatever that means for you.
Absolutely. Yeah. I think the problem when you first start, there's nothing wrong with wanting money. Like, we're both investors. We like money.
Totally.
Right?
Totally.
So it's totally a good motivation. But at some point, if you're like me, you're going to find that the bigger challenge is once you start getting money is how do you say, I have enough? Like that's tricky. Like
What was that like for you?
Still it's an ongoing struggle, but having a partner who you can have discussions with, I think helps a lot. Having somebody who you can kind of talk about values and what's important to you. For me, being a parent, it was like a big deal. Like, just, it kind of forces you into a less selfish, hey, I just got to serve, these kids need me. I got to do what I got to do. So I think it got me thinking about other goals other than just climbing and growing. But I think another thing that was just, I think we lose our imagination, or at least I did, of like, what are you really passionate about? What are you good at? And so it takes some self-reflection. And I think sometimes it's so easy to quantify making money that it just becomes the default way to measure life, instead of saying like, well, maybe me spending a certain number of hours serving these people in this way, even if I didn't make money, would really be fulfilling to me. It would really do what I want to do on this earth. That's harder to quantify. It's a little bit more fuzzy. And yet when people are sitting on their deathbed, they typically talk about the relationships they had, the impact they made, the people that they left a legacy with. Like, those are the things that we really are deep down really important to us. But it's hard to, can we build that into our business model? That's what we've tried to do. I have a business partner when I say we. So we've had kind of fits and starts where we've gone down the path of even trying to grow big in 2007. And we had some painful moments trying to just survive through the Great Recession. And it forced us to that's typically what I learned when I touched the fire. It forced me to learn about, wait a minute, do I really want to get big? Do I really want to do that? Or would it be going this other direction where I keep it smaller? That's how I learned. But hopefully people can learn by listening as well.
Right. Yeah. No one's on their deathbed saying, don't you know, I own 760 units.
Yeah, exactly.
Well, I suppose, Chad, there's a good chance we've already touched on a few of the 7 rules of the small and mighty real estate investor. But for either the rules that we haven't touched on yet, or just if there are any of those 7 rules that you really think stand out for someone just getting into this, or if there's just a couple of the 7 rules that are your personal favorites, can you talk us through those?
What we just talked about, another way of describing it is life first, business second. I think it's so easy, and I'm pointing to myself here, it's so easy to let the money is fun, the quantifying and the growing and the building a business, it should be a lot of fun. By the way, if you're getting into real estate and it's not fun, or if you're not kind of curious about it, it's probably the wrong thing to get into. There's other ways to make money. if you just want to be a lot more passive and just press a button, own index funds. I own index funds as well. Like that's a nice passive way to invest. Like real estate's, even when it's passive, it's more involved. So if you're not having fun with it, you shouldn't be getting into it. That being said, though, like it's the biggest deal, I think, and one of the rules that I try to emphasize and try to set apart with my style of real estate investing is putting your life first and working it backwards from those values, getting clear on what's important to you. If you have a family, if you have a partner, what's important to you as a family. And then don't be afraid to measure success a little bit differently. And what I'm going to say is like, sometimes if you have 5 properties or 2 properties or 1 property, that's not going to look as sexy on Instagram to say, oh, my 2 properties, look at me, but that's okay. Like I want to validate that and say, that's awesome. Like that's amazing. 1 property, 2 properties can set you, just 2 properties could make you more income in retirement than most people make from their Social Security check. Isn't that amazing? Like that's right. That should be, we should celebrate that instead of just saying the most successful people or the people on the pedestal who have all this money. We should I think we should celebrate those people who have worked their tails off, have got 2 properties, they paid it off, they've changed the trajectory of their family, they're living a better life. That's not as Instagram worthy maybe, but I think it's really cool.
I mean, there is a magical dollar amount out there, Chad, or maybe not dollar amount, but there's a magical amount of money. It's just, I don't think many of our listeners are aware of it. It's called enough. It's going to look a little different for everybody. But when you've met someone, or if you've reached that own point in your life when you say, oh, I have enough, whether it's the money I've socked away for retirement, whether it's the number of rentals I own that are supplying me cash flow, to sit there and say, I have enough to do anything and everything I want to do in this world. And isn't that great? That is a wonderful thing. So Chad, for any listeners right now who are either saying, okay, I want to go read Chad's book, check out his podcast, check out his YouTube, any other content channels I'm missing there, Chad, how can people find you?
That's the best place. Yeah, if you just search for Coach Carson on YouTube, or I publish on YouTube every Monday. I'm going to start doing an extra podcast episode on Fridays and audio only. So if you listen on Spotify or any of the podcast channels, just search for Coach Carson or Real Estate Investing with Coach Carson. That's the channel. And if you like to read a book, I've written 2 books. One's called Retire Early with Real Estate. The more recent one is called The Small and Mighty Real Estate Investor. Both are published by Bigger Pockets. So you can look on Bigger Pockets website and search for my name, or just Google my name plus The Small and Mighty Investor, and that'll come up.
Awesome. And listeners, we will do the homework for you, and we will throw as many relevant links as we can in the show notes. So Chad, Coach Carson, thank you so much for stopping by the Best Interest Podcast.
It's been a pleasure. Thanks for having me, Jesse.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.